Good afternoon, everyone. I'm Emily Drake, Managing Director at Fairport's Cleveland office. We're welcoming clients from all of our offices today, which includes not only Cleveland, Buffalo Grove outside of Chicago, Harrisburg, Pennsylvania, Buffalo, New York, and most recently, Princeton, New Jersey. We hope, like the market, your year is off to a positive start. As always, it is our pleasure to serve and inspire you and your families. Based on past feedback, these webinars are scheduled on a quarterly basis, and you'll see leaders from all Fairport offices take turns moderating. The goal of the town hall is to connect you directly with one of my favorite people, John Silvis, our Chief Investment Officer. He'll recap where we've been, his thoughts on where we are today, and what the year ahead might bring. We asked for questions in advance, and John and his team have prepared slides addressing those and other frequently asked questions. Be assured your advisors are in continuous contact with the investment team, and here are some ways that you can be too. You should be receiving Fairport Perspectives via email. The first one of these went out on January 6th, addressing our team's thoughts and themes for the year 2023. If you're interested in weekly updates, ask your advisors to share Market Note that comes out on Tuesdays or Wednesdays. You can subscribe to Fairport Flash, a monthly podcast on Apple Podcasts, Stitcher, or Google Play. Finally, you can follow the hashtag Investing with Fairport on LinkedIn for frequent thoughts on the markets and economy. As always, you're muted on this webinar and we are unable to see your faces. If you have questions during the webinar, you can type them into the toolbar and we'll answer as many as we can, time permitting. With that, I'm going to turn it over to John, our Chief Investment Officer.
Thanks, Emily. I appreciate it. And thank you, everybody, for tuning in. I know it's a busy time of year, but I appreciate it. We were just talking about this before we got on the webinar about, we started our first one. I think it was April of 2020 was our first town hall. Everybody's kind of back at your house, hunkering down, trying to figure out where to go next. And one of the things we talked about back then was, the big run on toilet paper, right? That was the big deal then. You couldn't get to Costco or wherever. We've gone a long way since then. In 2021, we had a pretty good year in the markets, kind of back to normal. Bitcoin was the big craze then. It was 60,000, was going to go to $1 million. Last year, due to the war, people started hoarding gas, so that gasoline was the big thing. And now it seems like eggs are the new toilet paper, I guess you could say, Emily. So keeping a close eye on the price of eggs. Hopefully that will come down like gas prices have. But it's been a roller coaster ride for, I guess for almost 3 years now. We're just quite a little under 3 years, but never a dull moment either in the markets or I guess in life in general. So for those people that have a hoard of chicken eggs out there, you may want to share with your neighbors if you can. So let's kind of get into it. I think the first thing we'll do is just kind of get into a 2022 in review. As Emily mentioned, feel free to send your questions in, and she can get those to me. And we have had a couple prepared in advance. But before we get started, any thoughts or any questions out there, Emily, or you maybe just jump right into the review?
I think you're going to address this in the first part, but a question that keeps coming up is, we had quite a year last year with everything being, pretty much everything was down. So, have we seen this in history before?
Yeah, so actually I will show you a slide on that as we get down. It's a little further in the deck, but definitely a question I'll answer. If I don't get to it, I don't answer the question, let me know and I'll circle back to it. But I guess you kind of hit it on the head. It's been a difficult year for both stocks and bonds in 2022. I'm kind of glad to turn the page on the year and move into 2023. We've kind of finished it with a whimper, not a bang. Fourth quarter was actually okay. We had a bottom in in the month of October for the stock markets, pretty much all stock markets, and the S&P was up about 7.5% for the fourth quarter. So really, on average, that's a pretty good fourth quarter, but relative to the rest of the year, still finishing lower than we'd like. And then bonds bounced a little bit in the fourth quarter as well. They're about 1.6%. But as you can see from that third column from the right, commodities did well. Cash was one of the better asset classes. We don't always assume cash as an asset class, but I think we've got a lot of questions on cash and how you get better returns, and we're happy to have those conversations with clients if they want to give their advisor a call. But as you can see in that third column from the right, fixed income is down about 13% for the year. Domestic equities, meaning basically Europe, Australia, Japan, those type of developed markets were only down about 14%. Large cap equities, which are represented by the S&P, was down about 18%. So as you can see, it was a rough year in the market, but really at the end of the day, it's probably a rougher year in the bond market than it was in stock markets relative to historical trends. We'll talk a little bit about that later, but to kind of put things in perspective, I think that the two things we talk a lot over the previous town halls, and sometimes it sounds like we're redundant, but we're just being consistent on what we see is the things that drove the markets in 2022 is the Fed policy. Not so much that they were raising rates, but I think it caught people off guard how fast they raised rates, and then just the struggle we've had with inflation being much higher for longer. And although I think that's coming under, that's improving as well, and we'll talk about that. But to kind of give you a bigger perspective, over the last 3 years, equities, and I'll say equities as represented by the S&P 500, we're up about 7.7% a year over the last 3 years. So, again, 2020, although it was volatile, was a pretty good year. 21 was a good year. 22 was not so great of a year. Over the last 5 years, the market, or S&P 500, was up about 9.3% a year annualized over that time frame. So some of this is just kind of going through the cycle of the market and having a refresh within equity markets. You're going to see down markets at times. Talked about fixed income. Really, fixed income saw the worst returns in the last 50 years. I already mentioned they were down 13%. As you can see in that bar on the far right, they were down 17% at the low. As I mentioned, they did have a little bit of a rally in the fourth quarter. Rates went from 4.5% on the 10-year Treasury down. I don't know exactly where they finished the year, but right now they're about 340. So definitely have come down, and that's helped a little bit. But definitely one of the worst years we've seen. And as you can see, that you don't tend to have two bad years in a row. You had a negative year back in the early 90s. Again, I think that's in 2012, if I'm not mistaken, it was down 2%, and then 2022. But the year following that tends to be a positive year. I think that trend will continue this year as well. From our standpoint, we try to keep our duration shorter than the benchmark, which has been helpful. We added some hedged equity to portfolios, which again I think was a benefit, and I think that will continue to be a benefit going forward. It tends to help alleviate some of the volatility you saw both in bonds and stocks. And then, again, we still think that the shorter end of the curve, that 3 to 2 year range, is probably where you're seeing the best value out there. But definitely was a tough year. But not only for fixed income, almost all asset classes lost money. This is a chart from BlackRock, but it shows all the different, excuse me, it shows all the different asset classes as defined by Morningstar. So if you ever see Morningstar mutual funds, they have several different ways they allocate or way they classify those funds. So there's 112 of them. As you can see in that far right, 94%, 105 of them lost money last year. If there's a positive there, if you go back and look at years when you've been around 80% or more, back in '94, you've seen a positive year, meaning most of them made money, so only 4% lost money. In 2008 had a bad year. In 2009, only 2% lost money, and so on. So hopefully we'll see that repeat itself going forward. Again, we think we'll see a positive return in both equities and fixed income this year. And we'll talk a little bit about that as well. And then really the one thing I think that just drove most of the volatility in the year 2002 or 2022 was just the rapid rate increases in Fed policy. As you can see, that red column or red streak all the way to the left of that chart says labeled 2022. We went from basically 0 to 25 basis points all the way up to 450 basis points. Now, ironically, most people thought at the end of 2021 that by the end of 2022, which was only a few weeks ago, that the Fed policy or Fed funds rate would be around 1%. So just to kind of give you how off they've been, and how much quicker they've raised rates, and that's really will have effects on the economy going forward. It takes about 12 months. So that's something we're definitely keeping an eye on. I think that's really what drove most of the volatility throughout 2022. I think we'll see continuation of that in the early part of the year, just because the Fed will continue to raise rates, I think, at least at the next meeting, if not the next few meetings, and something we'll continue to see going forward. So I think we'll see a continuation of what we saw in 2022, at least in the first part of the year. Have some other bullet points. We'll talk about that as we get through the process. But I'm going to pause there before we really get into the economy and what we see going forward. A lot of talk about recessions and things like that. So I'll pause there, Emily, if you have any thoughts or questions.
Yeah, I just wanted to ask, if you're in cash and you still think the Fed's going to raise rates, do you think you wait to invest if that money's geared towards fixed income, or do you go out to that 2 or 3 year mark where you find some value?
Well, I think right now, I think the best value on the curve, and when I say the curve is like different parts of where interest rates are for the 3 months, the 6 month, the 1 year, 2 year, 10-year treasuries. As you look at them, it's actually inverted. So the further you go out, the further it goes down. So for example, you get a better return on 1 year treasury than you would on a 10-year treasury. That's what they mean when they say the markets are inverted. But I actually talked to Rick D'Amico, our colleague who heads up fixed income, and I asked him this morning, where he still thought the sweet spot was, and we still like that anywhere from 3 months to that 2 year part of the cycle. So I think if you have cash and you want to invest it, I think you probably want to keep it still short in duration and short on that short end of the curve. I think there'll be opportunities to reinvest that, but I think you're going to see at least one more Fed increase. It's probably likely you're going to see two. Could be both 25 basis points. That's still up in the air. So I think it's still going to be a little more defensive there. I wouldn't go too far out on the curve yet, but I think that's something we'll reevaluate as we go through the year. But I would say, and we've had these conversations with clients, and I'll add it today, and this as well, Emily. If we have clients out there that have issues with short-term cash or looking someplace to park it, it used to be the old saying that cash was trash, and there's really no, you got 20 basis points if you were lucky. Really didn't matter where you put the money over the next 12 months. But that's definitely changed. So we've come up with some opportunities. There's a couple of opportunities either in treasuries or some of these short-term ETF or mutual funds. So if people have questions on that, I would definitely contact their advisor, and we can help them on that.
Great, thanks. So one other question in the chat, which I suspect you'll get to towards the end, but if you're not timing the market and you're not picking and choosing, how are you creating your portfolio design for volatile markets, such as the one we're experiencing?
Yeah, I will touch that. I think the quick answer is, we've been a little more defensive in our posturing. We've been a little more defensive in our duration, as I just mentioned earlier. So keeping it shorter, shifted probably more towards a core or even maybe a little bit more value in our portfolios, which tend to do better in these more volatile markets. But we are believers it's time in the market, not timing the market. So we're not moving the cash. We're not holding higher levels of cash or short-term instruments because of that. But definitely maybe taking a little more defensive posturing in our portfolios. So that's probably the short answer. But I will actually mention a few of those things as we go through. So you'll see that again as we get through the market and the portfolio comments. But that'd be my short answer on that.
Great, thanks. That's all for now.
Okay, so great. So, as Emily mentioned, we talked about our themes for the year. Uh, we kind of sit down as an investment team and come up with what we think is, how 2023 will play out. You don't get them all right. I think, last year, to get a good example, we thought they'd raise rates. If you'd asked us, we thought they'd raise rates 4%, but no, we wouldn't have thought that. So we had the direction right, but probably not the severity. And that, that tends to happen as you go through. But I think the big themes in the economy is, I think the first one, we're likely to see a mild recession. The consensus out there is we'll see a recession sometime middle to late part of the year. There's only one thing. I think there's three options really out there. You have the soft landing, which the Fed has kind of indicated, which is basically you avoid a recession. You have the mild recession, which is kind of a reset of the economy due to all the stimulus and tightening that we've seen over the last few years. And then the last one would be, something more of a hard landing or more of a traditional or even more severe recession. I think we're more in the somewhere between soft landing and mild recession. But I do think with all the data we're seeing, and sometimes it becomes a self-fulfilling prophecy that could happen. We'll talk a little bit about that. Unemployment rate we think will rise. We're starting to see more and more layoffs announced. Emily and I were talking about this earlier today, but Amazon and Microsoft have announced layoffs. But not only tech companies, you've seen other industrial companies, even financial companies announce that. So third point there is, I think the Fed's going to continue to raise interest rates, at least in the early part of the year, probably one or two more times, as I mentioned earlier. And then lastly, we actually think the Treasury rates, especially in the 10-year, probably peaked at 4.5%, at least for the what we call the intermediate term for the next year or two. We could see that go higher, but we think that's kind of setting up for a positive year, at least as a total return for bonds. I don't think we'll see large returns in bonds, but I think we'll see a positive return in bonds. So really, it's been somewhat of a tug of war here on the economy. We if we do see a recession coming up, it's like the worst kept secret, or everybody's talking about it. But so far the economy remains somewhat stronger than people have anticipated. The fourth quarter, which is just ended a few weeks ago, if you look at the Atlanta Fed GDP Now survey, they're looking at about a 4%. That might come down in the next few weeks, but we're going to get that GDP number, I think, 2 weeks or a week and a half. If you go back to the third quarter, we grew at 3.2%. It's very likely the fourth quarter grew at probably 3% or better. So I think from that standpoint, things look still pretty good. The company survey that we look at from ISI or Evercore ISI, which again has been a great indicator of recession, especially when it crosses that red line there, which is 40, a reading of 40 or lower. So far, it's been holding in there. It got as high as 60. It's been bouncing around in the mid to low 50s, but again, it's starting to show some real resiliency, and it's popped up again. So don't think we're in a recession as it is today. How close we are to falling into one is a better question. But so far, I think, we're early in the fourth quarter or first quarter. We're only a few days into it, but so far things look like they're still holding up pretty well. The unemployment rate, this is a chart from the St. Louis Federal Reserve, but just shows you really we've been consistent as you look over to the right side of the chart there, somewhere around the 3 to 3.5% range. Pandemic low is 3.5. We just hit that again. So again, so far, unemployment still stays relatively low. The Fed's summary of economic projections, which is something they publish every time they have a meeting, they have a estimate of 4.6% at the end of 2023, which I think is a pretty far from where we're at today. If we would get to that, if we get above 4% or that 4.25%, we probably wouldn't be in a recession. So that's one of the things we've been looking closely on. It's been a pretty good indicator, but there are other signs out there that would say we're already in a recession or heading close to one. On the left there, the 10-year minus the Fed funds rate. That's what they call the yield curve. It's inverted, as they would say, meaning the Fed funds rate's higher than the 10-year Treasury. And usually that happens within 6 to 12 months. You see a recession. So we're kind of on watch there, and the same with the leading indicators on the lower right there. they've crossed over that zero line. You can see that dark line there that says a recession signal. So definitely some mixed signals out there so far, but I would say it's inconclusive if we're in a recession yet. I'm going to skip over that one. The other one that would, be a sign of recession is Ned Davis does this model, and it's been very good. It uses state conditions like unemployment rate and state tax receipts and things like that. And usually once it gets above 15, with the exception of probably 2011, it tends to signal that we're probably entering a recession. So we're not quite there yet. They'll get the December number come out here in about a week. So that could change, but as of now, still not there yet. So I think that's kind of the big call for 2023 is, do we see that recession? And if so, when and how much of a recession, and does the market find a new bottom in the first quarter in anticipation of that? And those are questions we're going to answer as we go along. But signs of inflation, I think if there's a positive, as I mentioned, the two things that we watched closely last year, which was Fed policy and inflation. I don't want to say we won the war on inflation, but I think it's heading in the right direction. We had that June high of 9.1, as you can see right there in the middle of the screen. We finished, that's an estimate of 6.7. We actually came in at 6.5 for December, and projections are that we'll see it continue to go down. I don't know if we'll get to the Fed's target rate of 2%, which is what they've mentioned several times as where they would like to be. But I think we're definitely seeing us getting closer and closer. I think, and finally, I've shown this chart before, but this has been updated since the last time that the Fed tends to stop tightening the Fed funds rate when it's higher than inflation. And as you can see, the blue line has to be higher than the red line, basically, or the pink line, I guess it is. And currently, all the way to the right there, we're at 4.5% on the Fed funds rate. It's likely they will raise to 4.75 here at the next meeting, 25 basis point rise or increase, and inflation's at 6.5. But again, I think at some point they're going to cross this year, and that's going to be when the Fed will probably either announce some type of pivot or a pause. And I don't know if that's going to be in the first quarter or the second quarter, but I think we'll see that sometime this year. That's definitely our base case. Talk a little bit about the markets out there, but I'm going to pause, Emily. Any questions?
Yeah, John, so if you had to choose just 3 of those indicators, economic indicators, which would be your top 3?
3 economic indicators. Well, I like the company surveys. I talk about them all the time. They come out weekly, which is I kind of like. So you get a real-time indicator. If that drops below that 45 line, I would be somewhat concerned. So that's one. Consumer net worth I've talked about before, but that's unfortunately only comes out once a month, so it's a little harder to read, but that does tend to give you an indication. It's come down recently, which would indicate that we're probably going to see some type of a slowing in the economy, if not a recession. So I think that's another one. The third one, I'd have to think about it. I'm probably going to miss one because you caught me off guard, but I guess the unemployment claims again come out weekly on a Thursday morning at 8:30 from Bureau of Labor Statistics. Everybody, they talk about them on the TV. They're no secret. You can get live updates on your phone, but we're around 207, I think, was the 4-week moving average. I've been told by other economists if we get above 270, that's probably going to signal a recession, and that's 270 on a 4-week moving average. So that's something we'd be probably closely watching, or the unemployment rate, which is only monthly. But again, if it gets above 4, I'd say 4.2 is probably would be a definitive sign that we're probably either in or close to entering a recession. So those are what we'd be watching. The best probably discounter of those things might be the markets. The markets tend to know in advance, and they tend to move. The same with the bond market, and the bond market's definitely coming off the high. We went from 4.5% not too long ago to 3.4%. So rates have definitely come down. They're probably advocating, one, that inflation is cooling, and two, the economy is probably slowing. So I don't know if those are the right ones or not, Emily, but if you ask me tomorrow, I might give you three different ones, but those
It's
are
a good
the
answer,
ones in my
John.
head today.
It's a
So,
good answer. So as you're going into the markets, you may be addressing this, but as we all know, international has been behind domestic for a lot of years now. Is it, are we moving into a time period where international may be outperforming domestic?
yeah, so I will talk about that, just to kind of put it in people's heads, and you don't see it on the headlines a lot, but the ACWI, which is the All Country World Index, it's a benchmark we use. It's a global benchmark in nature, and it actually did better than the S&P last year. So it's the first year in a while we've seen that. It was a very slight difference. I think it was about 1% difference, both down. So it wasn't taking a victory lap in any way, but definitely did a little better. We tend to think that's going to happen again this year, or it has a better potential, and I'll get into why. So I'm going to just jump right into the slides here. So, again, market themes for the year. If we just kind of go through them quickly, we think there's a possibility we could retest the lows this year, but we think the S&P will generate positive returns for 2023. It might be a second half story along the way. I think volatility will continue in the first half, but then wane in the second half. Corporate earnings are most likely to come under pressure throughout the year, and we're starting to see that right now in the fourth quarter earnings, but that's technically fourth quarter of 2022, so we're advocating that 2023 we'll see some pressure. Could even see a down year as far as earnings go year over year. We had another close election. I think that's just kind of the norm nowadays. All these elections seem pretty close. We had a change in leadership in the House. Gridlock and divided government tends to be a good thing for capital markets, so we'll talk a little bit about that. We haven't talked about it yet, but there's this looming debt ceiling that's going to be out there, so that'll be the first big thing. And then, to your point, Emily, the dollar's really broken down here. I mean, we had a big rise in the dollar in 2022, much like we saw rates and other things rise, and much like we've seen rates come down and inflation come down, we've seen the dollar come down as well. That tends to help international stocks over domestic equities. I think it's probably what helped fuel it last year, and I think that could continue into 2023. Just from a valuation standpoint, we finished the year right about the 25-year average, just slightly below it at I'll call it 16.7. The 25-year average is 16.8, so we're below that. We've pushed as low as 15 times forward earnings. I think for long-term investors, valuations are attractive. They could go lower here. They could, peak down below 15 again. But I think if you have a 3 to 5 year time horizon, I think valuations overall still look pretty attractive. Mentioned the interest rates. They've come down quite a bit, but that gray line or band, as you want to call it, is kind of where they were on the high end, and that wasn't that long ago. We've seen a drop here recently, but still, as I mentioned earlier, the 3, the 1, and the 2 year down here in this end of the curve, you're still getting over 4% over a 1 year period or less on an annualized basis. So still think that's kind of the more attractive end. I think we're going to see a Fed raise rates at least one more time, perhaps two. So you could see that rise a little higher on the short end. That's kind of where we've been focusing, that 1 to 2, or that called 3 month to 2 year. As we get closer to the Fed decisions and they get, start to forecast their pausing, that may change, but that's kind of where we've been focusing. And I think, as I said before, cash is not trash anymore. So for those people looking to put money aside for taxes or a house or something like that, there's some attractive valuation or attractive yields out there. So, it's no doubt we're in a bear market, but, you tend to see rallies in bear markets, and then eventually one of those rallies turn into the beginning of a bull market. I'm not advocating that's happening currently, but even in bear markets, there tend to be some seasonality. So the first 4 months of the year, the January, February, March, April, tend to do better in bear markets, and then you get in that mid time of the year. Wouldn't put a lot to it, but I think, as a sign of hope out there, or a sign of seasonality, that could be what we would call a tailwind. We're kind of in the better part of the market. And I'll talk about that a little bit more as we get into what's next at the end of the presentation. Same thing with January effect. The first Santa Claus rally, we didn't get a great one, but we did see a positive return of 1.4%. First 5 days of the year in January up 0.8%. If we get a positive return in January, and I'd say that's on the fence at this point, but I think today is the 18th, so we're technically halfway through. We got another half of the month to go. You tend to have a pretty good return over that year. So I'm not going to say we'll get the average return of 27%, but I think that plus we're coming off the midterm elections, and I'll talk about that a little bit as well. And then really following the last interest rate hike, and I'm going to go out on a limb and say the last hike will be in March. I think they're going to raise rates in February, and I wouldn't be surprised to do one more in March, but that's that's up in the air at this point. So if that is the end, returns tend to, following the last interest rate hike, tend to look pretty good. I think there's a good chance we'll see that last interest rate hike in 2023, probably in the first half of the year, not the second. But again, timing's a little tough on that. And as you can see, going back to '94, stocks go up about 20%, bonds up 11%. I won't advocate that we'll see returns that high, but it kind of goes back to our thought that I think this year we'll see positive returns in both bonds and stocks, and those could be somewhat muted, but I think we'll see better returns, and I think a lot of that could come back loaded, but we'll keep a closer eye. So I'm gonna stop there. I know we're probably going a little slow here, so I'll try to speed it up as we go. But any other questions out there, Emily?
No questions, John, but I just want to make note that we should all write down that John has predicted our last interest rate hike in March.
Yeah.
That may come back to haunt you, John.
Wouldn't be the first time. So, you can't be wrong if you don't make a prediction, right? So,
Well said.
anyway,
Well said.
yeah. So, it's kind of where we're at in the sector. I think if I would have showed you this last year, we probably would have been exact opposite of this, but we've definitely moved to an underweight in technology. As you can see there to the far right, it says weight differences. Technology is second from the bottom. We're we're underweight by about 2%. We're overweight by about 2% in industrials. I heard someone mention it, and I thought it was a good comment, so I won't say it's my own, but he made the analysis that you want to be buying stocks and things. If you dropped on your foot, it would hurt. So I don't think a computer chip would hurt your foot, but I think if you dropped like a piston on your foot, it would hurt. So kind of more than industrials, machinery. We own obviously John Deere and things like that. So I think that's going to go out and continue. The valuations look attractive for industrials. Have creeped up a little bit on consumer discretionary. Still positive on healthcare as well. Usually when you get in these late innings of a rate hike cycle, healthcare does well. The other thing is when you go into a new bull market, what led the first one tends not to lead the second one. So technology was definitely a leader, and I think there's a good chance that maybe technology won't be the leader. Doesn't mean it can't have positive returns, but maybe it won't be a market leader if and when we come out of this current bear market. So value should, and I think it will continue to outpace growth, especially as the secular trend holds. You can see this is a chart from Ned Davis. It's a little busy, but really you have green and white bands there. The green bands are when growth outperforms. The white bands are when value outperforms. And it tends to go in fairly long cycles. There's been a couple of shorter ones here, but I think we're probably going to see a continuation of that value over growth in 2023. We've definitely changed the makeup of our portfolio to be a little less called growthy, and leaning a little more towards either a core or start to look at more value areas as well. And we've done that in some of our ETF models going forward. So if you haven't seen that, you will. So going back to your question about the international markets, and I think the one thing that might favor them this year is the uh, the dollar's reverse trend heading into 2023, and usually when the dollar is declining, that red circle is supposed to be right here, and right here is where you're seeing the 50-day average move below the 200-day moving average. So we're seeing what they call a dark cross. They used to call them a death cross, but that's not politically correct anymore. So they call them a dark cross. So that tends to be a good sign, just like we saw last year in 2021 and then into 2022 when they cross on the upside. You're going to see the same thing here. I think you'll see a correction in the dollar, and that should be a pretty good tailwind to some of the equity markets overseas. To your point, it's been a long time since we've seen that. As you can see in this chart, I think we're going to see some purple on this chart over the next year. I don't know how long it'll last. It could be short in nature, but I think we're going to see some reversion there going forward. Out of the international markets, we tend to like emerging markets, and we've been a little overweight emerging markets. It hurt us last year. It's helped us in previous years, but there is a guy at JP Morgan called Michael Semblist, who puts this chart together. If you overweight the U.S. and emerging markets and underweight Europe and Japan, you tend to outperform, and it's been a pretty good indicator over the call it the last 30 years. And I think a lot of it has to do with where does capital go? It goes where the growth is the best, and the U.S. and emerging markets have the best growth rates. If you look at Europe and Japan and the birth rates they have and how slow their economies are and how much they struggle, it tends to make sense. So I think we'll continue our slight overweight to emerging markets as we move forward. I'm going to stop there, and then I have a couple of things as we look forward into the year. Any questions? Any comments?
Yeah, I think a question that I often get is, when does the real estate market cool off?
Yeah, so that's a great question. A lot of our clients own real estate through a exchange traded fund or an ETF that's pretty broad. So it has both commercial and residential and multifamily and industrial and all those things in it. So there's a lot of different areas of the real estate market to look at out there. I tend to be a little underweight real estate at this point. I think that was at 4.5% on the 10-year as the treasuries come down. They're competing against yields out there. You can get a 5%, you can get a 4.5% return on a 1-year treasury with quote unquote no risk because it's a treasury. It's a tough comparison. So, it's existing home sales are coming down, slowing. We're definitely seeing, I can tell you, in my neighborhood, you're seeing a rollover. So I think residential is definitely slowing out there, mainly because of the higher mortgage rates. Some of the more commercial areas still seem to look pretty good. Data centers look really good. Seems like you never go wrong in Manhattan if you own real estate. So it just depends. But I think overall, I think the sector is probably going to be an underperformer in here as we get higher rates, and I think higher rates for longer. But I think, there's opportunities out there. And I know some of our clients will own private real estate, and that's another option out there. So if you wanted to talk to your advisor about it, we can set something up on that as well. So yeah, no problem. So, what to watch as we get into really basically just starting a new year here. This was asked earlier about the 60-40 portfolio, and again, if you look at the most recent year, 2022, it was down about 16%, that 60-40, give or take, depending what you were invested in. We've seen a couple years in the past. Rarely do you see them go down 2 years in a row. You saw that in the early 70s, and then during the tech bubble, you saw that as well. But you don't really see that. And most times when you do have a down year, it's the green, which is the equities that are moving it down. the gray, which is the fixed income, tend to be in positive territory. This is one of those rare years where they were both down. So that was non-conventional. You normally don't see that. I think again, I think we're going to see rates come down. Well, we also saw rates come down in the 10-year. I think the Fed's going to finish raising rates. As BlackRock has mentioned, it tends to be a good time for both equities and bonds. I think we'll see slight positive years. I think the 60-40 portfolio, I know a lot of people are calling it dead. I think it's a little premature. However, we have, considered using alts and have used alts in a lot of our client portfolios, especially, either buffered equity positions, which are structured in ETF form. We use some hedged equity portfolios as well. We can get into some more things like private equity and those things as well. If someone's interested, again, you can talk to your advisor. We can talk about some of the options out there. But I think we'll see a better return. I think it's a little premature to call the 60-40 portfolio obsolete at this point. To kind of end things on a positive note, we finished the midterm elections, and you've heard me harp on this before, but we're in that sweet spot of returns, and you get to that the beginning of November, which is in the midterm year. This is the midterm year, into the next year, which is the third year of the presidential cycle. 24 will be the year of the election. You tend to have the best 12-month return, and lo and behold, right about October, we bottomed. November, which is the beginning of the rally, held so far. We've had some corrections along the way. This isn't a forecast of where it's going to be, just historically how it's shaped up. So we definitely have what I would think a tailwind behind us as far as entering the strongest period of the cycle. It doesn't mean that the Fed can't knock you off track. It doesn't mean that we won't see other things out there that could derail the markets. And again, there's a lot of things that help climb the wall of worry out there nowadays. Other thing that just tends to be the case over a long period of time is gridlock tends to favor higher market returns. There's a red arrow there. That's when the Democrats own the Senate or control the Senate. The House is Republican and Democrat president. Historically speaking, returns have been pretty good. Not a lot of data points on these things, so I don't put too much into it. But again, if you're looking to build some mosaic out there of where we think returns can go, I think it's more of a positive than negative from that standpoint. And then rarely do you see two negative years of declines. We've seen it back again in the tech bubble and back in the early 70s, and that was about it. Both early 70s, I believe you're fighting inflation, other things, and then tech bubble was just valuations going forward. So 21 of the 21 declines out there, 18 times stock market was up the next year. So we have a little bit of a tailwind there as well. But I think before we ask if there's any questions, I think where we're at in the cycle today is, yes, I think the first half of this year can still be volatile. I think the Fed is pretty close to being done. We got the PPI numbers, which is the producer price index today, which is similar to the CPI numbers. They reinforce the idea that inflation is coming down, so I think we're seeing that. Could we have a retest of lows? That's possible. But I think we're close to that. If we do see a recession, our thought is it's going to be mild, and markets tend to bounce early in recessions and tend to lead out of recessions. So we'll see how it plays out. I think we could see that again, get into that classic why is the market going up if we're in the middle of a recession type of mentality, which we've seen before. But I would just caution people, if you're waiting for the Fed to stop raising rates, you're waiting for inflation to come back down, you're waiting for earnings to bottom, if you're waiting for the war to end in the Ukraine, and you're waiting for the debt ceiling to be decided, and you're waiting for China to reopen, and then once all those things happen, you'll get the all clear, and you move back into equities, or you say, now I want to buy stocks, you most likely will miss the if not all the returns, the bulk of the returns. And that's always kind of the tough thing. That's why I mentioned earlier, it's more about time in the market than timing the market. And I think that holds true this year. I mean, I listed off 7 or 8 things there. They're all something that can keep you up at night and all something that could derail the market on any given day. How much of that's baked in is always the question moving forward. And I think as we get on the back end of Fed policy tightening and hopefully the continuation of inflation falling, I think we're setting up for what I think is going to be a better part, either second, probably better 2023 than some people think, and probably a better second half as we go through. So I'll stop there. I don't know if there's any other questions.
We don't have any other questions, but I'm just thinking about all the things that you said we were waiting for, and I don't know that that'll ever happen. So
Right.
that was a long list. So
Well,
I guess the
you speak
message,
to clients all the time and they always have a reason, right? It's like,
right,
well,
right.
we have this, and those are all true. I mean, all those things are true, but if you wait for that all clear signal or the white smoke comes up and everything's ready to go, that's like the market bottom in March of 2020. Everybody was stuck home in lockdown, right? And end of March, April, May, June was some of the best returns, and most people weren't even working at the time because of lockdown. So you almost have to kind of assume the discounted process of the way the markets work, and that's why it's always hard timing the markets. But I'm going to go through these 2 things because if I don't, I get in trouble. So there's our disclaimers. But anyway, if there's not any other questions, I appreciate your time, Emily, and appreciate Annika and the marketing team helping us get this all together. And as I mentioned before, and I always do in client meetings, if you have questions or you want to speak to someone on the investment team, myself, if you have any questions on fixed income, my partner Rick D'Amico will be happy to have those conversations as well. Reach out to your advisor. We're happy to do a Zoom call or phone call, or I'm happy to meet in person, whatever is easiest for the client.
Okay, if before I let you go, I did get one more question. You stated that growth over the intermediate term would be driven by value stocks, not technology. What would we need to see to have tech lead?
So I think the reason tech has come under pressure, maybe I'll rephrase the question a little bit. I think the reason tech has come under pressure is because, one, rates have moved up. So the cost of capital has got more expensive. And growth has slowed, right? So it slowed in 2020, then it picked up and slowing again. I think for tech to lead, it's a cyclical process, but I think for tech to lead, rates would have to continue to come down. The Fed would have to announce that they're done raising, so there's some kind of pivot or pause announcement from the Fed, and we get back into that low inflation, low growth environment we were in for the last 12 years, where tech did pretty well. We had inflation of 2%, and growth was somewhere between 1.5% and 2.5%. We just kind of chugged along, and cost of capital was low, and I think if we got back to that environment, you could see tech, be a market leader again. I think it could be a leader. I just don't know if it'll be, tech and everything else like it was during the previous 10 years.
Thanks. So before I let you go, I have a couple of plugs to put in here.
Sure,
so,
go ahead.
If you're a woman in the Cleveland area, we'd like you to think about attending our Solutions for Women dinner on February 16th with wealth advisors Dana Hastings and Beth Korth. This is a signature financial literacy program geared towards women with a goal to learn, connect, and celebrate. Contact your advisor for more information and to RSVP. And all of our other offices, be on the lookout for emails inviting you to some upcoming virtual programs like this webinar and/or in-person events that may be in your area. We really want to thank everyone for joining us today. It's good to have your time, and it's a privilege to inspire you and your families. We're sincerely grateful. So make it a great day, everybody.
Thank you.